to see if it works. We're trying AirPlay and some other options because it looks like the TV has to catch the HDMI somehow. It's not doing that right now.
No, you know what I could do? Put on the more speakers. Plug the laptop.
How do you?
We have a plug.
Does it have a USB? The speaker? Yeah, just check if it has a USB. But the speaker?
It has a USB.
Oh, but that's the power.
No,
Yeah, it has a port.
Right.
But he doesn't have an extra port, does he? He has another USB port. Okay, that is doable. That is doable. Okay, so now we just need a USB port. Okay. Does anyone USB port? Yeah.
We need an Apple charger. This is that's actually okay.
In the meantime, let me try something very simple here. What we're gonna do is this AirPlay. So how do we do AirPlay?
Maybe you know, we can train them.
Yeah, do you know how to do AirPlay on iPhone? I'm pretty sure you don't need any of this. If I can just do AirPlay, everything will work.
Just go to settings and type in it. Early search for it.
I can discover. Now, how do we find this? Handnuts. What is handnuts? It says start something one and something.
Sometimes it's fun to listen to me. Like I'm listening to me that.
It has to show the device, right? I guess like in Bluetooth or something, or would it show up in one of these? AirPlay.
It's not.
How did you do it?
I will just
Okay, I
try
got it. I got it.
yeah, just this one. I don't think you will. So I don't know that you can the number.
We have to input the number, but
Yeah.
that is the. We are in. I think we are.
Oh, maybe I'll try to
Enable to connect.
Yeah, 334. No. 0771. 0771.
Yeah, all right. All right, so now
maybe
Just
mute from there. Just unmute from here. Mute that.
what I'm saying is that should be.
Okay. All right. Now you hear it through the TV. You gotta turn down the volume there too, because you'll get pushback.
Oh,
How's this?
it's my screen.
No, so just disable yours. Ah. Yeah. Okay. Make sure the volume there is off. Volume has to be off. Okay. Now.
How's the sound now? Better?
Bill, we're trying to project via AirPlay from my phone onto
Okay.
the TV. We almost succeeded. Let me try it one more time because
Okay.
it seems like it's a bit keeps disconnecting. Maybe it'll ask us for the password again.
I found a gentleman might be next for you. He works in a company 2 floors down.
Oh,
So
very
you're
kind.
not getting any audio out of the.
Yeah, the HDMI was. I think it's because the setting on the audio, or we're almost at the point where we can do AirPlay from this. So
Exactly, right? So it's sending the video, the audio to your speakers. Where do you want the audio to come out?
either from the TV or either
From anywhere. Right?
Yeah. So if you have a USB, even this could work because this audio might work with the USB.
It says USB in.
Yeah, I think so.
It's off.
I think you can just tap it. I think you can just tap it. Oh, it's working?
Yeah.
Oh, now we're in the iPhone now, huh? Okay.
Back in the
There's
iPhone.
Bill, there's our speaker.
Okay, Bill, can you hear me now?
I can hear you. How about my sound?
Yeah, so you're back on the TV, but we still don't hear you from the TV. I've got AirPlay and we're back to the same problem.
Maybe.
Okay, let me know.
I mean, we're back to the same problem because it's basically,
Yeah, we want to hear the voice from people.
it's not coming out of the TV. Yeah.
What if we can connect the phone to a speaker, and then whatever comes in the phone plays on the speaker, we'll have the
Because
video
there's
here.
because there's no
But,
USB
we
connection.
need a USB, but the thing is, it has an Android USB port. So if we have so we can connect this to this for sure, but we need an Android.
What kind of phone is that?
This is an iPhone.
I have a headphone adapter that goes to 8 inch. Do you know what I mean?
Oh, that's
That's standard audio.
the standard. Yeah.
I have that.
I can use this one.
Uh-huh.
This is Type-C, right?
No, that's not Type C actually. Can you try it?
What's the input into this?
It's just
What's the input?
Android.
USB-C,
USB. The general
Micro
Android.
USB?
Micro USB. Yeah.
micro USB?
Here, you can check it.
Well, you know what we could do maybe?
It's here.
We could just, whoever has a laptop, set up a few laptops, watch it on a laptop.
this is
We get them televisions together, right? And some people
Is
probably.
that headphone jack in?
Yeah, that's a headphone jack.
Right, so if I can get you something that goes from there to that.
Yes,
right?
we're
Hold
all
on, I
set.
got it.
All right. Okay, I'm just
Try that. Well, the only problem is, you'll get feedback with multiple.
Of course, multiple laptops, yes.
Yeah. So I don't. The audio is the problem. The video we've already solved.
Yeah,
The video is
but
working
this is
fine.
this is not good video compared to what we had before, though.
Because it's going from the iPhone.
Yeah, right. There we go. No, that's-
But actually, with this, the video would even work. The issue really is the sound. Just try this again, buddy.
Yeah.
See if this does anything internal versus sound out. The challenge here is the sound. I mean, did you know how to do it
guys,
before?
I have a question. Could it be this? Maybe there's an input button on the amplifier.
Yeah.
You have to select the right input, but
Well,
oh the last one we didn't use.
I have
It.
an idea. You see what I
no,
mean?
you didn't use
Oh,
Maybe
the
it's
I mean
input
the
on
speaker doesn't
amplifier on.
speak.
Bluetooth.
So maybe if there's an input button. That's what it could be. No second here. Yeah, definitely, yeah.
Okay, actually, they changed the input, so gotta go back to here.
Yeah.
Oh,
The aux? Doc? Maybe TV then.
all right. Is you on how are you on online?
Well, I'm wondering whether maybe it goes from the TV to this. See what I mean? It has to be on the right setting though. You see what
It's totally ridiculous. The host wasn't here, and I mean, you guys didn't do a rehearsal. What the hell? This is not a way to run an event, guys. Come on.
Guys, you know what it could be? I have a suggestion. maybe when you plug in the HDMI into the TV, the audio goes to the amp, and then from there to the speakers. We have to have the right setting as far as the right input. No, look at the left dial. Turn this. You see? There's one that's called TV.
Be off. USBI part.
If this is TV, can you, are you able to mirror it on this? This is a smart TV, right?
Yeah. Well, I had the iPhone there on it, but you know, the problem is the audio.
Maybe, okay, now try. Go back to the sound, and now try to connect the laptop.
Mirror it now.
No, but go back to the sound. Put the sound back on. Now go back to the laptop. Yeah. You take it. Is it like an audio?
Hey, let's start. It's already 7 p.m.
It's because it's coming from the TV.
How's your sound now?
Okay, try to go back to the AirPlay. Okay, so now we go back to AirPlay and see if that works. How do you do this? Gotta go. What does Janet say? Make sure if you're using a phone on silent, make sure all devices have volume on. Yeah, hello. We're not brain dead.
Right, exactly. He can hear us, but just he's only hearing us. It's only yeah, exactly. Not loud enough on the laptop.
Yeah, then you just AirPlay and play to here.
Well, this question is why isn't the sound coming out of the TV though? Or the sound should. The gentleman said the sound should come out of these speakers. That's what he said.
It's connected to HDMI. So it's
Yeah, the HDMI is not picking up the sound. That's the issue. We're not sure why.
yeah, that's weird. The HDMI has sound.
Okay, now let's unmute the TV. Yeah, we're about to find out. Okay, let's try now. Can you hear me?
Bill,
I can hear you.
Yeah,
it's coming out though.
It's coming on TV.
Can I try something?
Yeah.
Did we get it?
No.
We tried it.
We're still trying, Bill.
What's that?
Now?
Can someone? And now I'll be able
Hey guys, you usually play?
No, this is the first day.
Yeah, we have you loud and clear. We use a different connection now. But do you want to do the from here or from here?
We play in the league if you want to join us
You can
sometime.
play, I can't.
No, it's also for like practice also.
No, I still can't. I have some health issues.
Oh,
Can't do much.
okay.
All right. So now.
Oh yeah, we are good. We are good. We are in.
Okay.
Sorry?
I used to play a lot.
Mhm.
Now, basically after COVID vaccine, I have a lot of issues.
Oh,
So can't really do
is it because of the vaccine? Like what sort of issues?
Can you hear us?
increased heart rate for no reason.
Can't hear us. Let's go.
Yeah.
Guys, can you hear us or not? Bill,
Yes.
are you able to hear us?
Yes.
Okay, good. So we can hear you loud and clear. We've got a different speaker connected now, and I'm projecting from the phone through AirPlay. So I think we can start.
Okay, terrific.
Give that a try. Leon, why don't you introduce?
Okay.
Folks, we got the audio sorted out. Please let's try to.
Where's?
I can keep for now, if you guys don't mind. If you guys don't mind, I'll keep. Yeah, we play in the league. We also play like friendly. Sometimes, if you are interested, I could take your number. Yeah.
What days you play? Weekends?
Weekends, it's alternate. One weekend it's Saturday, other one it's Sunday, and it's we play in the hard tennis ball. So
Yeah, that'll be fun.
We can hear you, by the way.
Where do you guys play?
by 1:30 there is a ground, North Brunswick Community Park. There, sometimes in Milltown, sometimes in South Brunswick.
Hear you.
Yeah.
You can take my number.
Yeah,
You guys have teams. How is it?
yeah, we have teams, but it's just one team that you can associate yourself with. So I am associated with.
4 to 6.
How do I do this? How do I do this?
Ray. How are you? Sharma.
Are you living around here?
Yeah, we like.
Yeah, I live in Governor's Point too. Yeah.
What part?
I'm by Northam, so closer to BJ's.
Oh, okay.
Like right opposite to,
Sorry.
yeah, apartment.
We live here right
No,
now.
okay. It's cool.
You should be
Let me
next
know
to
when
that.
you want to start.
It's a WhatsApp group or what?
Yeah,
Should be next.
yeah. I'm
Unmute myself, right?
Can I? I don't know, you're gonna get feedback. So what do you want?
When you mute,
Are you speaking through there?
No.
Should I turn up volume here?
Let me know when you want me to start. Leon, you're muted.
Okay.
Bill,
I can hear you.
can you hear me?
Yes.
We can barely hear Bill.
Yeah, because the volume is on this, so it's not gonna work. Okay, all right, let's mute him then. Here. Okay, let's mute from there.
Can you hear me now?
There you go.
Bill,
Yes,
you can hear me, right?
I can hear you. How's my sound?
Yeah, we're okay. Okay, so let me introduce you then.
Great.
Hello, everybody.
All right, everybody,
We're ready.
we're finally ready.
Bill, we have a nice in-person crowd here.
Super.
Okay, so I'm very happy and honored to introduce my close friend and former colleague from Countrywide Securities, William Berliner. I worked with Bill very closely for a number of years in the mid-2000s. He's now managing director and head of fixed income research at PennyMac, which is a large mortgage originator. Actually, was founded by a couple of senior Countrywide executives, right, Bill?
Yes, that's right.
Yeah. So Bill has extensive experience in fixed income strategy, in hedging, particularly hedging of servicing risk, stuff like that. And he's going to give us an overview of both the primary mortgage and the MBS market. Without further ado, Bill, we're very happy to have you, and thank you again for agreeing to our request to speak. And take it away.
Super. Thank you. And I don't know how you want to handle questions. My thinking is if somebody has questions, we can you can just let me know, and we can take them out right there or do them at the end. I can do either way. You should be able to see my presentation. Basically here we're going to talk about a number of things, the Federal Reserve, and not necessarily what they did today, but more in terms of what they mean for the mortgage and MBS markets, mortgage rates, the housing markets and the MBS markets, and more importantly, the interrelationship between all these different elements. That's one of the things that really kind of struck me when I was putting this together, was how the circularity of these different elements. So bear with me and we'll explore the current state of the mortgage and MBS markets. So you can see here that mortgage rates are currently at their highest level since the great financial crisis. Last week, the Freddie Mac survey rate, which is one of a number of different measures of mortgage rates, printed at 6.02%, which is the highest level it's been since November of 2008. You can see from here that was when rates were on their way down. Now they're on the way up. Now, I mentioned a couple of other things. There are other rate measures in addition to the Freddie Mac survey rate. Some of them are, you can divide them into two different, a number of different categories. One of them is, are they showing contract rates, which is just kind of like a rate sheet rate, irrespective of points and fees, or is it showing an APR and basically it's a rate that takes points and fees into account. The Freddie Mac survey rate is a contract rate, but there's starting to be, issue publication of rates such as the ICE survey rate, which is an APR, as well as Optimal Blue publishes a contract rate, as well as the MBA, which publishes both a contract rate and what they call an effective rate. The other thing that's interesting is I found out on Monday, Freddie Mac is changing its methodology for gathering and survey. Now, the other element, that's somewhat different. Freddie Mac, since 1971, has been taking a weekly survey where lenders basically contribute their rates to Freddie Mac, and Freddie Mac compiles them and publishes kind of the average of those rates in the survey. The other way to do it that it can be done is an element where a system that takes, say, mortgage applications can compile the rates of the different applications and then publish a rate based on that. Now, Freddie Mac is moving from the survey to something similar to that kind of compiled system rate. And I asked them why. We're actually going to talk with them later this week. But mainly they're not getting as many responses as they used to get to their survey, and they're thinking that if that continues, it's going to make their survey rate increasingly unresponsive and not really representative of the market. So they're changing their methodology, and which is very interesting and something that is we have to look at and make sure that we continue some of the historical analysis that we've done for a long period of time. It continues to be relevant. You can see here that
Bill, I have a question for you.
Yes.
Is there anything akin to like a weighted average based on size of the transaction rate at which new mortgages are being originated? So the actual pricing of actual loans weighted by how much the balance of each loan, anything like that?
No, I'm not sure how they weight it. They're not, the various surveys are not entirely clear what they're doing. I believe more than a, kind of a balance weighted, I believe it's just kind of, an equivalent, closer to an arithmetic average of, in terms of the loan counts, because you're talking about, they're getting, hundreds and thousands of responses, on a daily basis. So they're compiling it. I'm not sure it would be effective to weight it, because I think it would larger loans tend to be made to more affluent people. So if you weighted it by balance, it would tend to be biased lower, all else equal.
Okay, thank you.
So, okay, on this slide, you can see this is using the ICE APR survey. But basically what this is showing is kind of the three components that are proxies for the mortgage rate. I would stress that this is not how mortgage rates are compiled, but it's representative of what's going on and will give you a good sense of how the markets behave. So the first element, the dark blue, is the US 10-year Treasury yield. You can see that's gone from 161 at the beginning of 2022 to 341 last week. It's actually like 353 now, but you can see how the Treasury long-term rate has risen. The second is the spread of the current coupon rate over the Treasury. And you can see how that's widened, and we'll talk about a little bit more about how much it's widened and why. But you can see that that spread over Treasuries has, over the 10-year Treasury has widened from basically 94 basis points at the beginning of the year to 217 basis points, which is a multi-year wide for it. Now, this is based on the current coupon rate, which is kind of an artificial calculation, but again, gives you a sense of what's going on within the market. And the last element, the light blue, is what they call a primary secondary spread. It's the consumer mortgage rate over this MBS current coupon rate. And you can see that that's contracted since the beginning of the year. And that's partly because as volumes have fallen, the competitiveness of the mortgage market has increased, and basically it's squeezed margins. And that primary secondary spread is a pretty good proxy for margins. Now, I mentioned that it's the ICE conforming APR, and I use that for two reasons. One, it's kind of a representative rate of what borrowers are really paying, including the points and fees, and also it's published daily rather than weekly. The Freddie Mac survey rate is a weekly rate, so for the purposes of this chart, it was more accurate to use and more telling to use the ICE APR. So one other thing I'd point out too, as I mentioned on the primary secondary spread, you can think that consumer mortgage rates would be even higher if the primary secondary spread hadn't contracted. Now, it will normally contract in this type of environment, but if it had stayed at the same level as it was at the beginning of the year for some reason, the mortgage rate, instead of being in the neighborhood of 6.25, 6.30, in this case might be 30 to 40 basis points higher. That's something to keep in mind, that which has held down consumer mortgage rates. So now one thing that's happened over the past couple of years since the COVID pandemic was that the Fed intervened heavily in the MBS market. You can see here, and this goes back to like the spring, like the week of St. Patrick's Day, 2020, when there started to be episodes where, say, treasuries, like 10-year Treasury was up 2 points and mortgage-backed security prices were down 2 points. So which was basically, how, it was indicative of how severely out of balance the mortgage-backed securities market was and how deeply troubled it was. So the Fed intervened heavily on this. They bought basically $50 billion a day for probably a month or so, and then scaled their purchases back. But you can see on this chart that over the course of, say, mid-2020 through the end of 2021, they were buying about $25 billion a week on average. So now with the tightening of credit conditions this year, the Fed scaled back its purchases and are preparing to let their portfolio of mortgages, MBS, as well as treasuries run off. For MBS, the target is $35 billion a month, although as we'll discuss, it's going to be challenging for them to get anywhere close to that in terms of running it off the portfolio. That has implications for the composition of their book over time. The scaling back of MBS purchases is one factor that's caused MBS spreads to widen this year so much. When you take 25 billion of purchases out of the market, kind of even gradually, that plus the impact of higher volatility has really pushed MBS spreads wider. But as we're going to discuss too, there's fears and concerns in the market that the Fed may be forced to sell some of their portfolio in order for them to get close to the meeting that runoff target. But we'll see what that means in a future slide. We'll go over that in a minute. Now we turn to kind of housing activity, which is, as we were going to see, directly related to the level of rates. But you can see that housing activity has pretty steadily declined this year. It's, the blue line is existing home sales, which is on the left axis, and it's basically declined every month since the beginning of the year. And even today it reported for August. And while it was off less than anticipated, it was still about 0.5% lower month over month. And you've also seen a decline for the most part in new home sales, which is on the right axis. And new home sales are a much smaller component of the housing market than existing home sales, but both markets have definitely seen declines in activity. We've also seen an increase in supply, especially in the new home sales. At 11 months, it's at its highest. That's 11 months of sales for new homes inventory. That's at its highest level since March 2009, whereas existing homes inventory is much tighter. It's about 3.5 months of sales, but you see that that's gone from basically less than a month of sales, which is not necessarily a bad thing because there was a lot of press about how few houses there were for people to buy. Now, in addition to housing activity slowing down, home price appreciation has also stalled. Now, if you look at the year-over-year numbers, you'd say, well, it's gone from 20.5% to 18.5% roughly year over year in terms of, and this is using the Case-Shiller 20-city index. But in reality, if you look at the month-over-month change, which is gives you a much better sense of what the market's doing now, you can see with the yellow line, that's the month-over-month change, basically annualized. So you've gone at the beginning of the year to something in excess of 30% annualized month-over-month change to about 5.5%. And it's another index which is very comparable to the Case-Shiller index, which is the index published by the FHFA, the regulator. It showed basically month-over-month home price appreciation going back to June, the most recent month, because there was a lag for that. Basically was unchanged. There's another interesting data point that I track. The median price of an existing home sale actually peaked in June at about, I think it was 420,000, and in August it reported at 396,000. So that price, that median price of an existing sale has started to drop. So there's a lot of talk about different markets, and some markets are experiencing home price declines. And you can see from here that the housing market is reflecting some of what the Fed has been trying to do, which is slow runaway home price appreciation. Now you see on this slide, this is something I lifted from the National Association of Realtors. Now it's very hard to get a long-term time series from them unless you're willing to pay them a lot of money, which I'm not. But you can see here, this is something that they published for a long time, and it's very telling in terms of what's happening to housing. So basically what this is doing is it's trying to calculate at a macro level the ratio of your average borrowers or your median borrower's income versus the payment, the necessary payment or the median payment on kind of your median or average home using current market rates. So I'll go over in a second what these columns are. The first column, the rate level, is simply they take some average rate, and I think they take the Freddie survey rate and kind of average it. But you can see that rates went up from the December at just over 3% to mid-5s in June. Median home prices have also increased. You've gone from 360 in January to 423. And again, this is not the median price of an existing home that I mentioned before. This is something that they publish. It's a little different than the series that they publish on existing home sales, but you get a sense of what's going on with home prices. They've gone up substantially since the beginning of the year. Now, they also estimate median income in the United States. The Census Bureau stopped publishing a median income I think in 2018. So the National Association of Realtors does their own estimate for what it's worth. Now, so what they're the number 4, footnote number 4, basically takes the median price of a home and the current rate level and calculates a monthly P&I payment from that using basically an 80% LTV. So it's, and you can see that from December, that P&I payment, principal and interest, it excludes taxes and insurance because those vary from state to state and even locality. But you can see that that's gone up from $1,250, $1,256 a month in December to $1,944 a month as of June. So once you take that number and then if you say take the median monthly income and take 25% of that, which is basically what they're, the kind of a proxy for a DTI, but it's just for principal and interest, again, excluding taxes and insurance, but taking median in 25% of median monthly income and comparing that to the payment, you can see that the minimum monthly payment is slightly greater than that 25% of median monthly income. And it wasn't that way a year ago. I mean, if you look at that ratio in June of 2021, it was 143, which basically meant that the median monthly income was 143% of the monthly P&I payment. Now it's 98.5%, which basically means that your median borrower's income is lower than the payment that would be necessary on the median home. I haven't been able to confirm this, but supposedly that number, that affordability index that they published, is at its lowest level since 1989. Although, as I said, I haven't been able to independently confirm that. But now, if you take that, one of the things they do also calculate in this calculation is the qualifying income necessary to make that payment. It's the qualifying income, which is basically the annual income necessary to make that P&I payment, assuming a 25% DTI, debt to income ratio. So you can see here on this chart, this shows two things. The yellow line shows the affordability index that we just talked about, but the blue columns show that qualifying income. And qualifying income has increased by about 55% since the beginning of the year, which is, goes to the large part to, well, that's what the Fed has been trying to do. They've been trying to slow housing. And on that regard, they've succeeded. Now, the question, though, is if you again look at the affordability index, the question is, what has impacted affordability more? Is it the run up in home prices, or is it the run up in mortgage rates? And what I did on this slide, you see at the bottom, the dark blue line shows again that 98.5 affordability index. But the other columns or streaks, if you will, show that if you had held home prices at the December level, but took June's mortgage rate of 560, basically that index would have been 114 rather than the 98.5 that it printed at. Do the opposite, you basically take 2021 December's rate, but June's prices, you can see that the index would be 131. So arguably, rates have had a bigger impact on affordability than the run-up in home prices, although I'd emphasize that both are a factor in this declining affordability. Another question goes, a lot of analysts would say, well, this is unsustainable. So either incomes have to go up a lot, everybody needs a raise, or home prices at the aggregate, the default to basically move affordability back to more normal and sustainable levels. Now, what's happened here, this is actually a really interesting chart because it shows two things. One is, this is 30-year agency conventional monthly issuance. And by conventional, I mean loans that don't have any form of government guarantee. In other words, it's issuance by Freddie Mac and Fannie Mae, excluding Ginnie Mae. Because there's some differences in the programs that I didn't want to obscure the point we're trying to get across. So you can see two things here. The red line shows how much issuance has declined since the beginning of 2022, and corresponding to the right axis, but also corresponding to the left axis, you can see that the composition of production in terms of the coupons that are being issued has gradually but noticeably transitioned. You see, for example, in January 2022, the bulk of issuance was in the 30-year market was in 2s and 2.5s. Okay, the 2s are the green line, and 2.5s is like the yellow blocked out line, with 3s also making up a considerable part of share of the market, and that corresponds again to the left axis. But you can see as you move to the right, when you go through June, July, August, now both issuance, as I mentioned, has fallen dramatically. It's probably fallen 40% from the beginning of the year, but also the composition of the coupons has moved up with the increases in rates. So now what you're seeing issued are 4s, 4.5s, and 5s, or at least in August. I've heard actually that there's some issuance in this market with the further move up in rates recently of some 5.5s and 6s. There's a little bit of 5.5s you can see here, but 6s means that those are mortgages that are being made with somewhere in the neighborhood of 6 3/4% mortgage rates. So that's really very important, and we'll go over this in more detail a little later. But that transition of the coupons upward has had a significant impact on the mortgage and MBS markets. Rising rates have also changed the composition of the mortgage market in terms of what's the loan purpose that's being taken. Now, there are 3 purposes that you generally talk about within the mortgage market for taking a mortgage loan. One would be to buy a house, which is the light blue line. It's called, call it purchase mortgages. The second would be a rate and term refi, which is just taking a refinancing of an existing loan to lower the rate, not liquefying any cash or any equity that's within the property. And the third, the dark blue line, is cash out refinances, where you're actually taking a loan, a bigger loan than your initial loan. You're refinancing the initial loan and taking out additional larger loan, basically liquefying some of the equity buildup. One of the things that's happened in the market, I don't have a chart for this, but home equity has skyrocketed with home prices. And I think you're somewhere in the, just equity alone is in the neighborhood in excess of, is it $30 trillion or something like that? It's a ridiculous amount of money that home buyers have reaped from just owning their homes over the past, say, 3 years. And one of the reasons that people have taken cash out refinancings is to liquefy that. Now the question then becomes, is there, at a certain point, are they going to want to refinance an existing low rate loan, as we'll talk about in a second, to take cash out, or will they find some other means to liquefy their equity, such as taking out a second lien? But you can see here that the composition of the market in terms of purpose has shifted dramatically, where at the beginning of the year, roughly a third of the market was rate and term refis. And you can see that in August, less than 5% of the market consisted of rate and term refis. 16% was cash outs, but 80% of the market was purchase mortgages. Big change in the mortgage market and in issuance. So to understand this a little better, it helps to take a look at the current composition of the mortgage market by rate. And in this chart, I'm showing the 30-year MBS market, but I'm also combining both government and conventional loans, just for simplicity's sake. And you can see that, since you've had, a huge refinancing wave that basically lasted for 2 years, it pushed the note rates of the outstanding market much lower. I don't have that handy, but if you look at this chart from 2 years ago, it would show a lot of, outstanding issuance in the 4% area and such. But you can see here as to how much, and this is in millions. So, you can see that the 2 7/8 is in the neighborhood of 700 billion outstanding. But this is outstanding balances, and you can see how tightly clustered it is around note rates between, say, 2 5/8 and 3.5%. So now, one thing that, okay, now if you take that data and you do a little manipulation, you can look at the percentage of the MBS market.
Bill, hold on. Bill, hold on one second, please. Bill,
Sure.
just one
Yeah, I'm
second. We're
here.
getting some feedback. Yeah. Somebody was speaking, I think, or
Is everybody on mute? Please mute yourselves, just want to make sure there's nobody else who has their speaker on.
Okay, no problem.
okay.
Okay.
So
Sorry, Bill, go ahead.
now, if you take those numbers and this is a little bit, I basically, if you look at this slide, I'm basically grouping everything in roughly 12.5 basis point increments. But then if you, just take the existing mortgage market, and you can create a cumulative percentage of the MBS market by note rate. So it's basically, so if you were to say, look at, I'm using 1 3/4 as the bottom, that's basically comprises basically, the market, it basically consists of 1 3/4 and higher note rates. That's 100% of the market. Now, if you look at the 3% note rate, that comprises about 70% of the market. You can see that the cumulative percentage declines as you go higher in rates, the way I've calculated it. So you've gone basically from, the Freddie survey rate was somewhere in the neighborhood of 3% a year ago. So what that suggests is somewhere around, between 60 and 75% of the market at that point in time had some form of a refinancing incentive. No surprise that prepayment speeds were very high. Now, you look down here where the blue shaded box, the survey rate ranges from, low 5% at the beginning of June to a high of, just above 6% last week. And you can see that the amount of the quantity of borrowers, the cumulative percentage of borrowers that had any kind of a refinancing incentive at all over that period ranged from 5% at best at its highs to basically 0. I've heard people say that maybe 0.5% of the outstanding MBS market consists of loans that have any sort of a refinancing incentive. Now, there's a couple of other things you have to keep in mind. Refinancings are also based on things like balance as well as just rate. And if you think about it, a larger loan, basically a relatively small, if you have an $800,000 loan, you might save, a 25 basis point rate savings might save you $130, $150 a month. Whereas if you have a $200,000 loan, a 25 basis point rate savings is going to save you $30. So that kind of implies that, the larger loans tend to be much more sensitive to refinancing opportunities. You have to keep that in mind when you look at a chart like this. It's not all apples to apples, but you can still get a sense there is not a lot of rate term refinancing going on now. The other is this concept that there's a lock-in effect. By the lock-in effect, that means that if you are a borrower that has, say, a 3% loan, and you're saying, well, maybe I want to trade up into a bigger house. Well, I'd have to, in most cases, I'd have to give up that 3% loan and take a 6 or 6.5% loan. Do I want to do that? So that kind of raises the possibility, that lock-in effect raises the possibility that home price or home activity, housing activity is going to further slow if that lock-in effect really takes place. Now, is it 2 or 3% lock-in effect really that significant? It's hard to say, because there still is some cash out refinancing activity going on. You can't exactly tell what the previous loan was. But you know, if the previous borrower had a rate of, say, call it 3.5%, they're now taking a 6 to 6.5% to do a cash out refinancing. And as we saw, you know, there's still 15 to 20% of the market of production is cash out refinancings. But the question is, if rates were to continue to rise, at what point does the rate rise really snuff out cash out refinancing activity? Now, I mentioned about MBS spreads are sharply wider, and this chart gives you a sense of the current coupon rate is a spread over 10-year Treasury yields. Now, the interesting thing is that current coupon rate is an artificial construct to a certain extent. It's an interpolation between, and basically this is the current coupon using a $102 price interpolation. A couple of reasons for that I really don't want to go into too much. But basically, the idea being that loans are generally issued and sold at like a 102 price, which basically means that there's kind of 2 points of, you know, overhead and profit margin in the in issuance. That's why you interpolate around that 102 price, but it's basically an interpolation, basically looking at the coupon, the price of the coupon below 102 and above 102. So there's some noise with that number, and when there's a shift in the market and the coupon that's above 102 suddenly goes below 102, that creates some instability in that index, but it still gives you a sense of MBS performance. And you can see how much it's widened. It bottomed out like in the spring of 2021 at 50 basis points, and it's now well in excess of 200 basis points, with a big change, a big widening coming at the beginning of the year. Again, partly because of the Fed throttling back its purchases and partly because of the increase in volatility in the market that we've all seen. Okay. Now, I mentioned that the Fed getting out of the market. So this is a chart that shows the Fed's MBS holdings going back to the great financial crisis. You can see that basically prior to October of 2008, the Fed did not own any mortgages, any MBS at all. But they started buying some as part of some of the post-crisis activities that they did to support the housing markets. And you can see that in September of 2012, they announced something that became called QE3, Quantitative Easing 3. And you can see how rapidly the portfolio grew. And even when they decided they were going to taper their purchases, leading to this so-called taper tantrum in June of 2013, the size of the position continued to grow well into 2015 or 14 there, where it stabilized. And then in June of 2017, the Fed announced they plan to let the portfolio run off using runoff caps. Now, at that point in time, prepayment speeds were significantly higher than they are now. So the Fed was able to meet those runoff targets, or the market was able to meet those runoff targets announced and put into place by the Fed. But you can see how the position gradually declined until the COVID pandemic and the reemergence of the Federal Reserve as an MBS buyer. And then their position rapidly grew, as you can see. Some people would call the COVID pandemic buying QE4. But you can see how the position increased until the beginning of 2021 and even into the spring of 2021, where it stabilized, and only recently has it begun to decline. Now, the Fed's targeted, as part of this quantitative tightening regime, they want to reduce the size of their MBS position by $35 billion a month. Basically, the logic behind that is the Treasury position is roughly twice the size of the MBS position. The Fed's on record as saying eventually they would like the position to consist, any holdings that they have, to consist entirely of Treasuries. But for the time being, they'd like to keep the composition of the position roughly, say, 2-to-1 Treasuries to MBS. So they're allowing the Treasuries to run off at a $60 billion rate, and that is very predictable. It's just whatever whatever matures of their holding. But with MBS, it's a little bit more complicated because the runoff is based on prepayment speeds, and prepayment speeds right now are very low. You're in the high single digits to maybe 10, 11% CPR. If you don't understand it, we can talk about that separately. It's basically an annualized payment rate, prepayment rate. But based on current speeds, you can estimate that the runoff in their portfolio would be about 20 billion rather than the 35. So the Fed could either let the share of MBS in the position grow, which they've said they don't want, or sell MBS. And the question is, okay, if they sell MBS, raise the questions of how much do they sell and what do they sell? Now, some of the street, most notably Citigroup, is on record as saying, well, what they should do is instill say a 25 billion floor in runoff and sell anything that doesn't, from the actual runoff to that 25 billion, which would imply right now, selling somewhere in the neighborhood of 4 to 6 billion a month of MBS. Now the question is, okay, if they do that, what do they sell? And then you have to say, okay, what do they own? You can see in this chart, this is the Fed's position. And you can see that basically, 70% of their overall portfolio consists of 6 positions. They own, conventional 30-year conventional 2s and 2.5s, and some 3s. And Ginnie made government National Mortgage Association 2s, 2.5s, and 3s. And then a smattering of other stuff some 15 years, some legacy stuff that they bought in that previous period. But basically 70% of what they own are, the conventionals and government 2s to 3s. And the bulk of that has been bought over the past couple of years. So it's very new. So now if you think about that, going back to the chart we talked about before about the upward shift in MBS issuance, well, you've created, or the market has kind of shifted into kind of a bifurcated state where you have a 2-tiered market where you can divide the market into we'll call the index coupons, as we'll see in a second, versus the production coupons. The index coupons is what the market has produced over the past years and comprise the bulk of the index and comprises the bulk of the Fed's holdings, whereas the mortgage market now is not producing that. It's producing 4s, 4.5s, 5s, etc. So now when I mentioned the index, this is the cumulative weightings of the Bloomberg MBS index. And you can see this, they classify things a little differently than the Fed does, which is why on the bottom axis. But you can see here the same thing. Basically, 50% of the MBS index, which consists of 431 different cohorts, but half of them is in the top 19 cohorts, which are basically conventional 2s, 2.5s, and 3s, and Ginnie 2s, 2.5s, and 3s. So you can see that both the MBS market and the Fed, the composition of their books is very similar, and it's all much different than what the market is currently actively producing. So now, and this again takes some of the issuance that we talked about previously and just looks at the breakdown for August, just taking August numbers in millions. And you can see that there's some, a little bit of like issuance of 3.5s, and this is 30-year conventional issuance again. So they've issued, about a little over 4.5 billion of 3.5s, 16.5 billion of 4s, and 26 billion of 4.5s, and then 22 billion of 5s. So you can see, compare that to this, and you can see how much different the composition of the of production is from the composition of both the Fed's holdings and the MBS market as a whole, which is why I think of it as a 2-tiered market. So basically those 2 tiers, the issuance tier versus the index tier, can perform very differently. So if someone were to say to me, how are mortgages performing? My response is, well, which sector, which part of the market do you want to know about? So what I did here, this highlights the tiering of the market. So basically what this is daily duration neutral performance versus the 10-year treasury. And that's on the left axis. So those are the columns. The red line, which hopefully, unfortunately, I didn't scale it quite as the way I wanted to. So, 0 on the right axis is somewhere in the neighborhood, like, negative 30 basis points for the daily number. But you can still see this, that red line is the daily, is the cumulative daily performance of 4.5s, which is a proxy for the production coupon, versus 2s, a proxy for the index coupon. And you can see that, they vary pretty substantially, Tom, over time. Like, through early August, the lower coupon actually performed better, which is why that's below 0. But you can see that from the middle of August onward, that the higher coupon performed better, in part because of that concept of that fear that, okay, if the Fed does start selling 2s and 2.5s, first of all, it's a big bump up in supply. Who is the marginal buyer of that supply? And who, and what happens to the market? So the supply itself is going to pressure the MBS prices in that sector, 2s and 2.5s and maybe 3s, but also raises the question, who's the buyer of that? Some people would say, well, insurance companies would look for these long dated assets. Some people would have said that, well, it's going to, serve as a competition to investment grade corporates. But that question really isn't solved. And that's one of the things, that question that's hanging over the market, especially when some of the Fed governors like Fed President Bostic and Mester were both talking about portfolio sales a couple of weeks ago. One of the things that really starts to pressure that sector of the market. But that's again why you have to think of it as a two-tiered market, because the performance of the production coupons can often vary pretty substantially from that of the index coupons. So now just
Say, Bill?
Yes.
Bill?
Can you hear me?
Bill, question. Yeah, Bill, question on that last graph. I'm just curious. When you do the duration weighting to look at this relative performance between 4.5s and 2s, right? I'm just curious. Is it a little bit kind of like almost like circular because you're using the empirical duration to do the weighting? And of course, empirical duration is you're not using empirical.
No, I'm using good question. I'm using yield books effective duration.
Let me just tell the group, what I mean is this. If you use empirical duration, you look at the historical movement of prices to determine what the weighting should be. But Bill is saying, no, he's using a yield book duration, right?
Yeah, which is a form of model duration. It's an, effective duration is basically a duration that's calculated based on projected price changes up and down. And, the normal calculation is up and down 25 basis points. How you get that, is the difference across models. Is it based on an OAS constant thing? All duration says is that it's a up and down price change based on quote unquote constant spread and a parallel shift in the yield curve. So in this case though, for my purposes, I'm using yield books durations on a, calculated on a daily basis. And you can see my sourcing is the yield book.
Hey, Bill, can you hear me?
Yes.
Okay, great. So on the previous slide, I'm curious, you mentioned that the current run rate of MBS is about 20 billion a month.
Yes.
And that, of course, may imply about a 10, 11-year horizon for this to
eventually go away. Yeah.
Wind down. I mean, is that realistic? I mean, do you think they'll accomplish enough tightening with the projected rate, or in your opinion, do you think they may have to accelerate the runoff?
Well, I mean, that is the 50 or the $2.7 trillion question. It's unclear. We're not sure what they want to do. A lot of it depends on whether they want to, how dogmatic they want to be about maintaining the composition of their portfolio. But it's clear, and at current rate levels that, and keeping in mind that they are continuing to push rates higher, at current rate levels, prepayments aren't high enough to meet that $35 billion target. And they're, and prepays now, which, I would argue is probably pretty close to as low as they would get without a catastrophic change. They're only running off at 19 to 20 billion a month. So, the question is, do they sell enough to get all the way to that $35 billion target? Do they kind of compromise and say, well, we'll let the MBS, the MBS get bigger as a proportion, with the idea that down the road, maybe rates drop and the payoffs will, the payoffs will be higher than the target and we'll kind of get even? Or do they just, kind of take a wait and see attitude? There's people who's, it really goes back to, what does the Fed really think is the most effective means of monetary tightening? Do they think that, and there's talk that, Powell is basically on the, of the view that rate hikes are more effective than portfolio, reduction. But this, and there's a lot of questions. I've read a lot of research, basically questioning what is, if they were, what is the equivalent rate hike to a $1 trillion reduction in their portfolio, because that does have a quantitative tightening effect, pulling reserves out of the system. So there's a lot of questions around that, and it's an excellent question that is unanswerable.
So, of course, chances are we'd have a crisis before, we may have another crisis before they actually end up getting very far with this wind down. And then they'll probably go back to 5 trillion or.
Who knows? This is a very, as the old line about living in interesting times. These are very interesting times.
So normally we try to keep these things very interactive, and I do appreciate your patience with this, Jerry Maguire solution here tonight.
Well, it worked. That's all that matters.
No, I meant a MacGyver solution out of Maguire. But in any case, we'd love to have more audience questions as you go along.
There was a question from a Samir, actually.
Well, I'd like to, let me just finish this last slide that I have up, because I think this is important. Because this, this kind of encapsulates, my thinking when I was putting this together, is the circularity of all these different things. You start with Fed monetary policy, which impacts the MBS market, which impacts the primary mortgage market, which impacts housing, which in turn feeds back to Fed policy. So now, if you think about that, so then the questions are, okay, if the Fed, sees, as I mentioned, if they seize their MBS purchases, who's the new marginal buyer of new production? Not even so much if they sell, but, with the fact that they're not buying any more new production, and what they were doing is basically taking production out of the market. Who's the new marginal buyer of MBS? Not clear, and that clearly impacts mortgage rates, because if that new buyer doesn't emerge, mortgage spreads are going to widen, and it's going to push primary rates higher. What happens to intermediate and long-term Treasury yields? That also flows through the mortgage rates. We saw today after the Fed meeting that the curve basically flattened some more, inverted some more. The long end of the curve did pretty well. But that's going to also flow through the mortgage rates. If the Fed sells their portfolio or some of their portfolio, who are those buyers? Does it push spreads on competing product like investment grade corporates wider? And again, what happens to housing and home prices? Is there a floor in say home sales activity, because of things like people moving, work from home, et cetera. There's a lot of talk about that. Citi actually wrote a very nice piece this week, opining that that housing turnover, basically the rate of home sales, is going to decline relative to the housing stock, and basically take out of the money prepayments very low. I'm not sure I agree with that, because I think they're underestimating some of the changes in the market from the COVID work from home thing that's cropped up. But that's an interesting question, and that basically, So if you go from, like right now, say the twos on average are prepaying, call it 6 CPR. If they were to prepay at 2 CPR, they say they're overpriced by points, by 4 to 5 points, because the yield is so much different if you assume 6 CPR, as 6% annualized repayment rate versus a 2% because of their deep discount. But those are all factors that are kind of intermingling and interacting with each other in the market. So, and that said, please hit me with some questions.
Bill, I think Samir, you had a question. Samir, are you there? Samir had a question for you about the composition across the coupon stack, I believe. Samir, do you hear me?
Hey, yeah. Hi, Bill. Hi, Leon.
Hi.
Hi, Samir.
So, over the past few years, the Fed has basically been buying the majority, if not more than the production of all MBS. And so their portfolio has all these 2s and 2.5s. But what is the true float in the market aside from their holdings?
Yeah, that's a good question.
Because the index is full of theoretical stuff that doesn't exist in the market.
Right. I don't think they've bought, more than the market. They've done it on occasionally, on a monthly basis. If you figure, issuance over the past year, say in 2021, probably averaged, I'm thinking, 250 to 300 billion a month off the top of my head. And they basically were buying, say, 25 billion a week, which works out to be about 100 billion a month. So they were taking a considerable amount of the float out of the market, which has a lot of implications for the MBS market. Like when, for example, when you trade a TBA, basically an MBS forward, you're making some assumptions as to what you're either going to deliver or get delivered, and that assumption, really does, changes in that assumption really impact your expectations for how the cohort is going to prepay and how it's going to behave, what the composition is, again, because of, with the Fed taking some of it out and the specified pool market taking other, basically adversely selecting the TBA. Bloomberg does a pretty nice job of breaking out the floats. And the floats are still, despite, the Fed purchases and, takeouts and specified pools and structured products, the floats are still considerable, but they're smaller than what they would have been and also more adversely selected in a lot of cases than they would have been. Now, one other thing that, that the Fed, taking the Fed purchases out of the market, basically they were buying, they bought, TBAs, and they got the, what was delivered to them was basically the worst of the worst, basically pools with large loans, very, very high FICOs, which from a prepayment standpoint is bad. Low LTVs, again, for credit purposes, it's good, but for prepayments, they don't generally, their prepayments are relatively fast, and keep in mind that the market was at a premium for much of the time. So they got delivered basically adversely selected parts of the market. Them being out of the market, that changes the composition of what now goes to investors, because the Fed isn't getting stuck with, to excuse the term, the dreck of the market. So, that's, those are, that's another factor to your point, Samir, that you have to keep in mind.
Well, the reason I asked, right, because this addresses who the buyer is going to be. So if let's say the average, I'm just going to make this up. Let's say the Fed's average coupon on a weighted basis is 2.5.
Yep.
Right now, they own the bulk of the 2s and 2.5s. The index's average weighting might be 3.25 or 3.5, let's say. But everyone else, all the money managers don't have the 2s and 2.5s, and the index contains them. So as the Fed sells these low coupon stuff, this is a chance for everyone to get back up to the index.
Right, but keeping in mind that like the weights of the index, and like say 2s comprise somewhere in the neighborhood of 10% of the index, and that's in excess of what the Fed owns. So the composition of the index is they own lots of 2s already. At least I would argue, they got plenty of twos. So for them to buy more of them, they'd be over indexed in twos.
Yeah,
Hey, Bill, you've got a pretty sizable audience here, so I just want to invite some questions from here. We've got one from Andy Calte.
Andy.
Hey, Bill.
Come up here, please.
I have to go up there, or?
Just project your voice. Do your best.
Bill, just a question. What are the prospects for Freddie Mac and Fannie Mae? What do you see them happening?
Yeah, really interesting. As far as them coming out of conservatorship, I would argue that, God willing, I live another 10, 20 years, we might be having the same discussion about them coming out of conservatorship then. There is no progress and there's no impetus to take them out of conservatorship. Now, in terms of their relative activities, you raise it, there's an interesting point to be raised. In 2019, there was a big change in the MBS market where you went away from trading Fannie Mae's and Freddie Mac gold securities, and you went to what's called a single security initiative. And basically, Freddie Mac and Fannie Mae became fungible, and they both issue securities out of the same pot, if you will. And with the idea that Freddie and Fannie are going to, quote unquote, maintain alignment. But now there's this issue with, where they started, because of capital rules, they started charging if Fannie Mae tries to securitize or re-securitize pools issued by Freddie Mac, there's basically a 0.5 point charge for it because in theory, there's a credit exposure that it's taking by Fannie Mae securitizing Freddie Mac's and vice versa. The regulators are trying to work their way through this, but that's one of the things that's kind of jumbled things is you did have for a period of time a pretty well aligned market where Freddie and Fannie were almost fungible. Now you're back to where they're really not fungible. Now, and Andy, to your point, was what does it mean for the future? I'd argue that the single security initiative may take them out of conservatorship even more difficult and more unlikely, because at that point, without the government's backing, they both have credit exposure and the credit exposures are not equal. So what you have the risk of is a tiered market or a fragmented market. If, say, Freddie Mac's finances were better than Fannie Mae's, people would want to get the delivery of Freddie Mac securities to the extent, and they would specify Freddie only in their TBA trades. That would tend to fragment the market and make it much less liquid. And that was always, I think, the risk of the single security initiative. And one of the things when they started talking about when they changed the rules to quote unquote align them with the things that they were trying to avoid. But again, with this capital charge, which is probably unavoidable based on the way the language reads, it now makes again them be less fungible and raises that issue again of the credit differences and how that would impact them if you didn't have government backing.
Other questions? How many slides do you have, Bill? And should we have more questions?
This is it.
Okay, fantastic. All right, please, Bill. Question. Hold on. Another question for you.
With the Fed keep on raising rates, when are they going to start running into negative carry on their portfolio?
Good question. My understanding is they're going to have negative carry by the end of the year, which basically means the Fed loses money. And the Fed has been making like tons of money over the past couple of years. I forget the number, it's like hundreds of billions of dollars. But now at the end of the year, you're going to have, the Fed start to lose money because of that. I think the interest they pay on reserves is going to exceed the interest, earned on their portfolio. But it raises another good point that some people have said. If the Fed were to start selling 2s and 2.5s, well, they're going to have like a 15-point loss on those positions if they, realized loss. Like right now, they would have they don't mark to market, so it's kind of just thrown in the closet and nobody worries about it. But if they were to start selling those positions and realizing those losses, their fear is that they're going to get dragged in front of Congress and have to explain to Elizabeth Warren and Bernie Sanders why they're losing the taxpayers' money and
They've been making a lot
how
of money.
many, and so they, the thinking, some people have said, well, the Fed's mandate is, inflation and, employment, nothing to do with P&L, but again, that's ignoring the political component that we all know is out there.
Bill, I'm curious if you've seen any analysis of the, left pocket, right pocket kind of, as rates go up, the debt servicing costs go up to the treasury, but then, you've got the Fed's P&L and then what the treasury has to pay. So, I'm just curious if you've seen some analysis on the net. Are we better off or substantially worse off as a result of?
Good question. I haven't seen anything specific to that. I'd have to think about that though, but it's an interesting case. I mean, you do have those cross currents again working. So it's not just a cut and dry decision.
Bill, what about the fact that you pointed out more than once that the stock right now is of Standing Warrior is very, very low coupon, even the Bloomberg index.
Mhm.
How about this? I'm a money manager, right? I manage to the index. Should I be happy that the net total convexity of the mortgage market is much lower, much less negative now because the index is made up of threes when the current coupon is 4.5? Does that incentivize me that it's a safer asset class because it has much less negative convexity?
Yeah, I mean, that's an interesting point, and that has been raised. It's, if you just manage, to the index and adhere to the index, you have less convexity hedging costs and risk than you have in previous years. But on the other hand, you also, there are other elements to it too, and one other thing that's kind of interesting is that with the Federal Reserve being the biggest buyer of mortgages in the world and being a totally passive manager, to a certain extent, that's all, historically, that's also kind of served a little bit to dampen market volatility because you didn't have these kind of tail wagging the dog things where, there's a sell-off and duration extends and all the money managers have to go sell to hedge up and further push the market out. I'd argue that the market's been more stable over the past, say, decade to 15 years because, Freddie, the Federal Reserve has been the marginal buyer rather than Freddie and Fannie, who were very active managers of their duration. Now, in terms of just the convexity of the position, yeah, it's definitely a less negatively convex position than it would be if or where it was, say, a year ago, when 2s and 2.5s were trading, at premiums, and a relatively small move really changed the index's duration.
I think David Zhang, Dave from MSCI had a question. Dave, are you there? David? Oh, maybe he dropped off. Yeah. Okay, sorry.
Let me just check if any more questions here. Otherwise, it's almost 8:15, and we can move into the networking.
Oh,
part
Dave,
of this,
one question here. I'm sorry.
Yeah.
One more question, Bill.
Sure.
With the Fed ceasing their MBS purchases, what impact does this happen on the private banks and their purchases of the MBS? Is there a correlation? Are there factors that lead to the private banks as well?
Private banks? Is that what you mean?
Private investment banks.
Oh, I see. What was the question? I'm sorry, I didn't understand the question.
With the Fed ceasing their MBS purchases, does that have a correlation with the private investment banks as well, with their purchases of MBS?
I think to a certain extent, what you could argue is that it's impaired the liquidity of the market, and for the purposes of the investment banks, the trading desks, it makes it harder for them to do their job of making markets. So that's another indirect outgrowth of the Fed kind of backing off both MBS, and you're seeing the same thing in the Treasury market, as I understand it. Where liquidity is starting to become a concern.
Yeah. Yeah, I remember when they floated the idea, Bill, about selling down the treasuries. The question was, the buyers the private buyers have to repo this paper. Is there enough capacity among repo lenders to to absorb that much more additional demand, right?
Mhm.
People looking for repo funding. I mean, the market didn't even have enough capacity, I think, to fund all
Yeah.
that paper,
And you
right?
had that, you experienced that, I think, in the fall of 2019, where you had, the repo market had some serious dislocations, which is when the Fed, I think, initiated their, their repo facility, which I think has helped that to a certain extent. But now you're going to test that with the runoff of the market and the, some of the closing down of liquidity in the market.
Any other questions?
One more, it's Samir again.
Hi, Samir.
So if they can't find enough buyers, what do you think of the idea of PPIP for agency MBS?
Of keep it for agency? You mean let Fannie and Freddie hold on to it?
No, PPIP, public-private partnerships.
Oh, okay. Interesting question. I actually had a conversation with someone, I am dating myself severely, but I had a conversation with somebody about, would they do something like, how many people in this room know what the Resolution Trust Corporation was, RTC?
I helped liquidate that thing.
Oh, excellent. Well, one person at least knows, but basically, so that would be kind of along, if I understand correctly, along those lines, but my sense is that would be kind of works at the margin, because the numbers we're talking about that the Fed would have to sell are just much bigger than the RTC had to liquidate. Some sort of a public-private partnership, but then, well, where does the money come from for the public part? That means you have to get, taxpayer funding, and everybody knows how popular that was last time around. So possibly, but it's, there are any number of solutions. Some of them are going to have, there'll have to be some creativity involved, I think, in figuring that out. But the only other, solution is prices go down and basically make it attractive.
Okay. Well, Bill, thank you very much for a fascinating talk. We really appreciate you taking the time to prepare this for us. We loved it. Thanks for becoming a member of the Quafa X family going forward.
Excellent.
And we hope to see you listening on some of our future events.
That'd be terrific. Thank you, and thank you for your invitation.
Okay, and thank everybody for listening in, and those of you in person, thank you again. The Zoom group, thank you for listening and participating, and we'll see you at our next event.
Bill, thank you. We appreciate it, and we owe you a dinner. So hopefully you'll join us for one of the speaker dinners. We do them periodically for folks that are remote like yourselves.
That'd be great. I would look forward to that.
We're actually going out tonight, and we wish you were here. So I'm sorry that you're not. But hopefully we'll get to do it in person. And thanks again for your patience with the technical glitches.
No problem.
I'm just happy that the iPhone somehow worked.
Yeah, right.
Yeah.
We were trying to MacGyver different.
Yeah.
So thanks a lot, and please stay connected. If you have other friends who want to speak and have ideas, we historically, because I'm an equity guy, we didn't get a lot of good fixed income presentations, but thanks to Leon's input, we've now got some very good speakers like you. So hopefully we can balance it out a bit, because I tend to gravitate towards equity and factor investing by default. And
By the way, I was telling Bill Milan that a number of the people that Mary Child spoke to at PIMCO for the Bond King book, Bill knows personally, right, Bill?
Yeah.
Yeah.
You sure you weren't the source?
I'm definitely not the source.
Yeah.
Okay,
right,
thank
friend.
you.
Take care, Bill.
Yeah.
Bye-bye.
Thank you so much. Okay. Cheers.
Good night.
Good night. And thanks to everybody on the cyber portion of this.
Right. Very good talk.
Yeah. Fantastic. Well, I'm